The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. This is an ESG edition. I talked to a pioneer of the ESG investing movement in New Zealand and asked what he thinks of the saying, go woke, go broke.
Ultimately, I'm still a capitalist. I want to make as much money as I can for investors. I just want to do it in a way that's positive for planet and ecosystems and people.
And the market regulator reveals if it's planning any action against funds making potentially unsubstantiated ESG claims.
That ESG or investing in a way that didn't cause people to have a reputation or a values-based jump scare when they looked at what they were actually investing in has become table stakes.
It's Friday the 28th of April and you're watching Markets with Madison. 3 letters, E, S and G, that now rule a large portion of investment decisions, with investor funds flowing to companies that meet environmental, social and governance standards. It's become so popular that the market regulator, the Financial Markets Authority, has taken a look at whether or not the claims can be backed up. Paul Gregory is in charge of FMA enforcement. Hey Paul, thanks so much for coming on. Is it likely that New Zealand investors are being fooled by potentially unsubstantiated ESG claims?
We've done quite a bit of work on this to sort of see what the state of play is in the New Zealand industry. We put out a report reasonably recently on this, which looked at a sample of investment managers, and we chose those who had used terms like responsible and ethical in their fund labels, or they'd use them prominently in their advertising, or they'd use them in their formal documents like a product disclosure statement. And we looked to see what they were actually doing. And amongst those examples, we couldn't see anything that was an egregious example of misleading members, but what we did find is a lot of vagueness, a lot of imprecision, a lot of use of terminology that it wasn't necessarily clear what was meant by it, let alone how you would substantiate it. So it was an immature approach. That's how we described it in the report. And it's really important to get that precise, to get that clear, because we know that choosing and using fund products and financial products in general is tough. And when you have to build your values into it, it just makes it even more complicated. So the clearer it can be, the better.
Since you put them on notice, have fund managers cleared up their act?
We certainly got a good response from the fund managers that we spoke to, and that we provided some feedback, quite detailed feedback in some cases. So we did see some changes and some additions to disclosure, so that was good. And we have certainly seen other fund managers who have been keen to let us know in the various meetings that we have with them about the progress that they're making on responsible investment policies, and things that they're joining up to, like the Responsible Investment Association of Australasia. So there's certainly some action happening, but we're always vigilant, and as you might have seen, there's some more pressure coming on the fund management industry in general, because across the Tasman in Australia, our fellow regulator ASIC has been taking some cases on this.
Would the FMA look to take any enforcement action on this if needed?
We haven't seen the same evidence here. But if we did, then yes, we most certainly would.
Almost all fund managers that I know of use external resources to substantiate or filter their ESG investments and claims. Can investors rely on those external sources? And is the FMA looking into them at all to see if the claims that they're making stack up?
Yes, so there's various certification processes or external standards like the UN PRI, for example, that managers can use, and those have been developed over a reasonably long period of time. So it's not for a regulator like the FMA to decide what is right to invest in or what people should and should not invest in. It really is about, if you're going to make claims like we're responsible or we're ethical, that you need to be able to explain what you mean by those and substantiate them. And it may well be that a part of being able to substantiate them and to explain them is to say, well, we invest according to this set of principles. Here's what the principles say. Here's the process for us measuring up to them. Here's how we're going, and here's how this is reflected in our portfolio. So that's a reasonably good description of how a fund manager could make it clearer what they're trying to achieve and how their portfolio and how their investments reflect what they're trying to achieve. which can include but does not have to include reference to standards like UNPRI.
How would you describe how popular ESG funds and offerings to investors have all of a sudden become?
So that's a pretty key point. The reason why we did our guidance a couple of years ago now in the first place is because it was very clear that ESG or investing in a way that didn't cause people to have a reputation or a values-based jump scare when they looked at what they were actually investing in has become table stakes. So it's become almost an expectation for investors now, retail and has been for some time for institutional. And so what that means is that in quite a lot of cases, if a investor believes that their values are being looked after in an investment, they are prepared to pay more. And if an investor thinks, well, climate change or animal rights is important to me, and if what I'm investing in is having a real material impact there, they might even be prepared to accept less of a financial return for that. And that's where it becomes really important if somebody is prepared to give up returns or if they are prepared to pay more for a product on the basis that they feel like their values are being well served. That better be true.
Thanks, Paul. Good to chat.
Thank you.
One of the stewards of ESG investment in New Zealand is Pathfinder. It set up one of the first KiwiSaver funds deemed ethical. Its chief executive, John Berry, says ethical or responsible investment has garnered a lot more attention since then, but it's also brought confusion.
Well, you've got to pick a names, I suppose, and you can say ESG, ethical, sustainable, green. We like the term ethical investing, so we launched our Global Water Fund back in 2010, which seems a long time ago now, and we had financial advisors saying to us, only nutcase greenie tree huggers will invest in this, because sustainable investing then was talking about climate change, talking about the world's water crisis, was a little bit left field. We tried to move it into the mainstream, which I think has happened in New Zealand, has definitely happened. Probably the biggest catalyst was if you go back to around 2017, everyone found they had cluster munitions, landmines, nukes in their KiwiSaver, and people wanted change and were appalled. The unfortunate thing, I suppose, then was the conversation started and stopped at what am I going to avoid and what am I going to take out of my KiwiSaver. The more important question for us, as an ethical investor, the more important question for us is, yes, I'm going to avoid harmful activities like tobacco and gambling, but where am I actually focusing my investment? What am I actually going to invest in is the more important question.
What do you make of the term go woke, go broke? Has that turned out to be true, or can you actually earn money and make good returns off ethical investments?
Look, 10 years ago, there was a very, very strong bias that if you invested ethically, you'd either lose money, you're a philanthropist, or the costs would be high. I think that's been pretty well disproven. And thank you for asking the question, because our KiwiSaver is, in the Morningstar survey, #1 in growth and conservative, and #2 in balanced over the last 3 years. So top of the podium, you can be ethical and make great returns as well. We call it duality. We focus on a mission of individual wealth and collective well-being, so this idea of making money for our individual investors. Ultimately, I'm still a capitalist. I want to make as much money as I can for investors. I just want to do it in a way that's positive for planet and ecosystems and people.
John, can you give me an example of a company that you've invested in or an asset class that has done well financially, but is also ticking all of those ethical investment boxes for you?
Okay, so a company I love is a small private company called WillAid, which we invested in about a year ago. They have made the world's first merino wool biodegradable band-aid. Young guy out of Tekapo made it. We invested in the company at an early stage to help them into the US, and they're going gangbusters in the US. And it's a disruptive product. It takes plastic out of the environment and provides a biodegradable solution. So in private markets, there's really high impact opportunities, but also in public markets, there's plenty of good companies in public markets. In the tech space, we're heavily overweight solar and wind, for example, in healthcare, social housing. We've done 3 social housing projects which offer commercial return for our investors, but at the same time help vulnerable New Zealanders into warm, dry housing.
What do you think makes an ethical company financially better off? Is it because they have a different mindset, or is it purely because consumer behaviour of the markets they sell into has changed, or is it perhaps just sort of the way that markets have gone for the 10 years that are working in your favour?
Yeah, look, I'd say what makes an ethical company is at 2 levels. Firstly, product. So making a product that's sustainable or lower carbon, has a clean supply chain, and then the business itself and how the business operates itself. And you've got to get both those things right. You're going to have higher staff engagement. If you're a company with purpose, you're going to have more engaged staff, fewer sick days, staff will stay for longer, you won't have to retrain staff constantly, you're going to be more profitable. If you care about the environment and you're a manufacturer or you're a chemicals company, for example, if you care about the environment, you will be at less risk of an environmental spillage or environmental damage, which means you're a lower risk company. So ESG metrics are often used to help you decide or look at the financial risk or the non-financial risks within a company and help you to make better investments, lower risk investments and hopefully higher returning investments.
Specifically on the returns though, what do you think it is about the fundamentals of those ethical companies that does make them look better on a financial level too?
So you can look at it through a consumer lens, you'll get stronger engagement, stronger reputation, stronger brand. You can look at it from a regulator's lens, like you're less likely to encroach on regulation if you're behaving ethically. If you're a financial services business, you won't be engaged in greenwashing, for example, and facing the reputational damage and the cost around that. Into export markets, European markets, for example, care deeply about the sustainability of companies. So New Zealand companies are going to have to think about their sustainability credentials for going into export markets. So it's basically every stakeholder in a business cares about the ethical nature of that business. And that's why there's such a strong drive into the B Corp movement worldwide, which is a certification process for businesses that don't just offer a sustainable product, but also operate their business in a way that cares about society and the environment.
Are ethical or ESG investments, are they a luxury that is ill-afforded with the market volatility that we're seeing now?
ESG investments, I would say ESG investments or ethical investments are better investments. High ESG companies tend to be high quality companies. There's research around in down markets how high ESG companies fall less, are less volatile in down markets. No, I'd say it's not a nice to have, it's almost a must have if you want to have good returns in your portfolio.
So say I want to invest in ethical companies or ethical assets, where do I start?
You can start by going to Pathfinder's website. But
I knew you'd say that. Other than that, obviously.
Other than that, look, just do your own research. There's plenty of options from ETFs, from active fund managers like us. There's KiwiSaver, there's managed funds. There's plenty of options. Even banks, you can choose your bank based on how much they lend to fossil fuels or whether they're a B Corp. There's plenty of options in financial services. Just do some research and ask your friends.
And if I was researching stocks, what are the top things that one should look out for to figure out if they are ethical or not?
If a company's ethical or not. So, I'd say authenticity is the opposite of greenwashing. So you're looking for authenticity, you're looking for really strong leadership, you're looking for good governance structures, you're looking for a company that can articulate its purpose as more than just about making short-term profits. They actually see themselves as having some sort of mission in the world around environmental or social issues. And they've got to be profitable as well. If they're not profitable, they won't be sustainable long term. So you've got to have both that profit and that purpose going at the same time.
Do you have an ESG red flag? Something that tells you to not invest in a company even if they tick most of those boxes?
Yeah, that's an interesting one because some low ESG companies can actually be good investments if, like I mentioned, change of leadership. If the leadership changes and the governance improves, a low ESG company can be turned around quite quickly and actually be a high-performing company. The easiest ESG flag is just poor governance, which is if you look at, for example, Facebook, the control one shareholder has on the company is a risk, a non-financial risk in a business, and a red flag for us.
Thanks so much for your time, John. Really lovely to have you in.
Thanks, Madison. It's been a pleasure. Thanks.
I want to know what companies you invest in because of their ESG values, or if you avoid any companies because of their lack of them. Or you may think ESG is BS. If you're in that camp, I want to hear from you too. Now go put your money to work.